Yesterday, the euro and the pound sterling extended gains against the US dollar, driven by rising expectations that the Federal Reserve would start cutting interest rates next year. The greenback slid despite upbeat data on US consumer confidence. The Conference Board's index increased to 102 in November, while economists had forecasted dipping to 101.0. However, speeches by some Fed officials exerted pressure on the dollar. Fed Governor Christopher Waller said that he would see a point where the Fed might start lowering rates in case of a continued decline in inflation over the next 3 or 5 months. The market is now pricing in the potential for the regulator to lower rates by as much as 100 basis points next year. Against this background, the US dollar is losing ground, thus paving the way for gains in risky assets such as the euro and the British pound. Today's macroeconomic calendar features a batch of statistics from the UK, including data on M4 money supply, mortgage approvals, and net lending to individuals. Germany is set to release data on inflation, which is expected to ease in November. If the indicator meets market expectations, the euro could come under pressure. Nevertheless, considering a weaker dollar, the European currency is unlikely to suffer heavy losses. The focus of market participants will be on US GDP growth data. The US economy is forecast to have grown by 5% in the third quarter, compared to the advanced estimate of a 4.9% rate. An upward revision of third quarter GDP will probably bring the greenback further down. Besides, traders may take notice of a speech by Bank of England Governor Andrew Bailey. Given that the British regulator is still in favor of further monetary tightening, the pound sterling has every chance of extending its rally against the dollar. Furthermore, Cleveland Federal Reserve President Loretta Mester is set to speak today. However, her statement will hardly lead to any dramatic shift in the market. And now let's move on to technical analysis. According to the 1-hour Euro-American dollar chart, a false breakout at 1.1015 will create a sell signal, thus dragging the euro down to 1.0978. If bulls regain control of the market and the price forms a false breakout at this level, a strong buy signal will be generated with the euro bouncing back to 1.1015. If the price consolidates above this mark and tests it from the top down, the volume of long positions will increase further. In this case, the European currency is likely to advance to 1.1058 and 1.1103. At the level of 1.1103, I recommend going short on a rebound to catch an intraday correction of 30-35 pips. Short positions at 1.1058 can be considered only amid a false breakout. Alternatively, if the price breaks below 1.0978, the euro will probably dip to the support levels of 1.0947 and 1.0921. At these marks, it would be a wise decision to go long on a rebound, counting on an intraday correction of 25-30 pips. However, this bear case scenario is possible only in the event of a stronger than expected upward revision of US GDP growth. Speaking of the British pound, the situation is similar. A false breakout at 1.2680 or 1.2640 will make it possible to buy the pair. Getting long on a rebound will be relevant at 1.2601. In the hope of an intraday correction of 30-35 pips. If the price breaks above 1.2728 and tests this level from the top down, one can open additional long positions, counting on a rise to 1.2761 and 1.2797. Although the pound sterling is in overbought territory, hawkish comments from Bank of England Governor Andrew Bailey could drive the British pound further up. At the level of 1.2797, traders are recommended to go short on a rebound to make money on a move of 30-35 pips. Short positions at 1.2761 and 1.2728 can be opened only amid the false breakouts. Best of luck.